Strong macro data and blowout US bank earnings were met with a muted reaction last week. Technical signs of exhaustion and extreme bullish sentiment increased the odds of a pullback, and the dollar breaks down to major supports, triggering a nice bounce in gold and other major commodities. All this and more in this week's Macro Insight. Okay, guys, welcome back to Macro Insight. Today is the 20th of April, and let's have a look at these markets. What's been going on? Market action. So the strong data, right, just keeps coming. So you had the data you had last week, a lot of macro data out last week. You had retail sales up 10% month on month, jobless claims sharply lower, improved business confidence via fully fed Empire Manufacturing, all printing high levels last week. The only slight disappointment was Michigan consumer confidence, which showed a lower increase than expected, but it was still an increase. Okay, and that was on the back of uncertainty on inflation expectations, apparently, right? But given all that strong data, market reactions to the data weren't that great, right? Maybe not as strong as we might have thought. So particularly interesting was the treasury yields reaction to the strong macro data, where we saw yields kind of moving down to about 157, actually touching lows like closer to 152, which was quite surprising in the face of good economic data. They've now bounced off those low 150s to about 160 again. And then also, if you look at the equity market leadership, that was being driven by utilities, healthcare, the defensive sectors, which is normally what you would not expect when you're getting blowout numbers, basically, right? And last thing, reopening stocks such as airlines and entertainment, they were on the back foot, and financials were also quite weak given their good earnings, right? So they had a knee-jerk rally up as soon as the earnings came out, but then they sold off and kind of finished the week a bit lackluster. Yeah. Yes, as you see here, last week we had that kind of sharpish move down to 152. That was one of my sort of consolidation levels. That was one of my retracement levels. We kind of bounced off it, and we're kind of hanging around that 160 level at the moment. Yeah. Now this sort of range. So I would say we could still call that a consolidation in yields. So I would still suspect that we're going to see high yields at some point over the summer. But, if that 152 level gets broken, then maybe we're facing something different, right? But I think you're going to need a bit of a bout of risk off, driven by some sort of other external kind of catalyst for us to really break down below 150 in yield. So for now, I would say the trend is intact, and it's just been a consolidation for now. Yeah. Now, in terms of, you've got to remember the market is a forward discounting mechanism, right? So the recent price action is basically suggesting that all this strong data that we're seeing may already be priced in to a large extent, right? And so we need to figure out what's going to happen next, right? Like, the market has already rallied pretty hard, and we're seeing the data that the market has been anticipating. So you're seeing a price action in the banks. We're going to have tech earnings next week. That's going to be something to keep a close eye on, right? Because if the techs can't rally on decent earnings as well, and they've got quite a high hurdles, right? They've got quite big comps to beat, and so you may well be in for a bit of a bout of weakness on the back of tech earnings if they can't really blow out their numbers and trade well on the back of it, right? On the bank stuff, I would say, what was quite concerning was the loan growth numbers. We've also got velocity of money, right? So that money's sitting there stuck in bank reserves, and it's just not feeding through to the real economy. And so this is the problem, right? So this big debate and this big discussion about inflation versus deflation, outside of the base effects, right? Getting sustained inflation with this backdrop, I think is going to be difficult, right? And, you know, the recent bond market reversal also kind of suggests that inflation is going to be fleeting. Obviously, the Fed keeps going on about it, saying it's transitory. And the stellar bank earnings that we saw were more a function of loan loss reserves being released. And that poor loan growth data is showing that future earnings might be harder to come by, right? So that's, I would say that was kind of partly explains the price action, and also makes you think that despite the decent numbers we're seeing on earnings, there are things under the hood to be concerned about, okay? Also the VIX, right? So the VIX obviously has been getting, I mean, for want of a better word, getting battered, right? Touched around 15, 16 levels. Now, you did have April listed expiry last week, and you do tend to have a bit of kind of cyclical weakness into expiry week. So we had that, and post the weekend, the VIX had kind of tried to stage a bit of a bounce. So you see here, we printed as low as sort of 15.5. We've tried to stage a bit of a bounce. But if you look at realized vol levels, they're not great. So you got 10-day realized at 8, 20-day realized at 10.8, and 30-day realized similar around 11.5. So when you've got front month VIX, once the April VIX expires, which is on Wednesday, you're going to have front month VIX, which is May at 21, versus realized vols tracking, you know, pretty much 11 and below, right? So there's still a reasonable gap there, which makes me think, you know, unless we can really start to move around a bit more, you know, these vol spikes are going to be pretty short-lived. And are likely to get hit back down quite quickly, right? I mean, we know that risk appetite has been coming back. As I've kind of mentioned previously, you know, in the vol market, the flows to the sell side on vol are back. There's variant swap sellers, there's overwriters, all things like that. And then you also have earnings season, right? Generally, what tends to happen in earnings season is the focus is more on single names, and the single names kind of disperse around, and leave the broad indices relatively muted and relatively unchanged, right? So I'm not expecting fireworks this month in index vol on the back of those factors, basically. Now, we could get a correction in markets, you know, but it does seem that that will be brought back fairly quickly, given the backdrop that we've got for Q2 in terms of, you know, macro. There's some sentiment indicators, you know, that are looking stretched, showing signs of complacency. There's like that bull bear indicator, the AA bull bear indicator. That's at an extreme level. You've got a gold copper ratio, which apparently signals, you know, complacency. You've got some momentum divergences, which you guys know I like to look at on pretty much every index, right? You've got momentum divergence. We have a look here. So you've got the S&P making new highs on weaker momentum. You had the same thing on the DAX. You had the same thing on the Eurostoxx and the NASDAQ as well on the 4-hour. So you've definitely got a few things that point towards a market that's a bit tired. Price action not being great post good data and good numbers, and the technicals showing various divergences, right? So, you know, these are things that would make me cautious, and these are reasons why I've taken profit on some tactical longs like the NASDAQ that I've mentioned. Yeah, nothing too sinister, but a 3 to 5% pullback I think would be healthy, would take some speculative froth out of the market, and it would provide us a foundation to basically rally on continued strong data over the summer. So that's kind of what I'm looking for. So, you know, other than, you know, if you're taking profit on tactical longs and just going more neutral, that's one way of doing it. Another way of thinking about it is stock replacement, right? Similar to what I mentioned on Real Vision. Stock replacement strategies, given that vols come down. If you've owned the market and you're thinking, you know, things are feeling a bit stretched up here, maybe you switch some of your longs into some calls that expire in June or longer. You don't want to go too short dated on those calls. You want to give them a chance to survive any drawdown and then recover again. So I'd be looking at anywhere June to September calls maybe as a type of stock replacement. Yeah. So that's kind of US centric sort of markets. You know, COVID cases have continued to go up. You know, global COVID cases are hitting new highs. India's experiencing the worst of it by the looks of things. On the back of that, the Nifty has remained quite heavy. Nifty's been a favorite of mine for a while. It's clinging on to that 14.3 level. That's the support. That's the first kind of confluence level. It's kind of it's fighting to defend that level right now. If that breaks, the next stop, I would say, major support is 13.9, and then again 13.5. Now, my longer term outlook for India remains solid. So I would look to kind of, if we got to those lower confluences, then I'd probably continue to accumulate India as a long-term hold, right? Because even if COVID cases do get worse and escalate, there will be light at the end of the tunnel at some stage, right? And then that longer-term trend is likely to kind of take hold again, right? And for me, the India story is a much longer-term story, yeah? And also there has been some positive signs in India of the potential peaking in the virus cases, like Maharashtra, the first state to be hit, is starting to show some signs of potential peaking, right? So that's a good thing. Mobility's gone down quite a lot in that area, and that's going to help cases drop, right? So, maybe some signs of relief there. In terms of Euro or European markets, the macro data has continued to disappoint in Europe on a relative basis to the US. But then on the flip side of that, European vaccine rates have picked up. Apparently, Spain is now moving at a faster rate than the UK currently. And European markets have been kind of reflecting a better rate of change in general for Europe. You've had the DAX outperforming. European markets are holding up, but they are still showing some of these bearish divergences, right? So I'm not saying go short them, but I don't see, I was long some FTSE calls, as you guys know, and once that break of 7,000 kind of didn't hold, and that was kind of my level where I was looking for an acceleration through 7,000, I bailed on those calls because they were quite short dated, and I'm expecting a bit of a pause in markets overall right now, yeah? So that's kind of where we are in equity markets. Coming up this week, things to look out for. It's like not too much on the macro front. You've got UK CPI on Wednesday. You've got ECB on Thursday. And then you've got some Japan CPI on Friday and Euro and UK PMIs on Friday, right? So that's US new home sales, right? So those are your macros, and nothing too huge, I wouldn't say. But you've also got a load of earnings. You've got Johnson & Johnson, Netflix today, ASML going to give you a read on semiconductors on Wednesday, Intel and Snapchat on Thursday, and Daimler and Amex on Friday, right? So quite a few big caps there will give you a sort of flavor of how the broader economy is kind of doing. Yeah. All right, so that's kind of where we are. FX wise, all about the dollar as usual. Let me bring it up. So dollar's had a bit of a slide, obviously. Let's bring up this. This is probably the one we want. Dollar's had a slide, and it's on a bit of a key sort of trend line here around that 91 area. I think that also coincides with like a 100-day moving average. And the momentum on the daily is pretty weak, right? So if that's a 4-hour, if we go to the daily momentum, that's pretty low, right? So it needs to bounce here really, right? If the dollar doesn't manage to hold this level, then we could be looking at a downside break of this trend. And then we go back towards the kind of bearish dollar dynamic that we were seeing, earlier or back end of last year, and certainly what people were feeling like early at the start of this year, right? So, on the back of that slide in dollar, you've had Euro take out 120. You've had cable kind of threaten that 140 area again after holding those 137 levels. And you've even had Aussie kind of pop its head back towards 78, right? So, sort of broad-based dollar weakness there. I mentioned last week the short side of this euro sterling trade because I wasn't really too sure where the dollar was going to go, right? It was a bit no man's land. But I did like the idea that cable was going to arguably outperform euro on the rally. So that's kind of worked okay. just a mean reversion play, really, thinking that euro had kind of rallied a bit too much last week versus the pound. You know, if this thing kind of keeps doing what it's doing in terms of the trend, you know, we could be looking at 85 quite comfortably. You know, I ran an 87.50 stop on that short. Now that we've kind of done the best part of a big figure, I'll probably just trail that stop to entry so it can't damage me. But right now, I'm not taking it off. Probably still look for further weakness there. Yeah, you've also got ECB meeting right on Thursday, and that might be a catalyst for further weakness or for some weakness because you've got the EU yields, right? The European bond yields have all popped, right? So, and the ECB is not really a fan of that, right? So the ECB is going to want to try and keep financial conditions in Europe loose, and because they need to spur inflation, right? If you look at inflation in Europe versus inflation in the US and what's being priced, I mean, it's nowhere, right? So they're gonna need to try and talk dovishly in that meeting, and if they do that, then at the margin, you'd expect euro sterling to sell off or continue its sell off from what we've seen, right? So I'm not really I'm not planning to exit that position before the meeting because I think that might actually give me the catalyst that I'm looking for a further slide in that position, right? Okay, and that's pretty much my main thoughts on FX. Commodities, gold quite interesting last week, breaking above that sort of key resistance that I've been flagging, which was 1765. Kind of in no man's land now. There's another quite major level at 1825. But you know, for me, if it rejected that 1765 level, then the down move was still on. But if we broke that, you know, I wasn't going to be too stubborn about it because it might still have some legs. If we look at sort of reasoning, like why did it rally? Sentiment, I've mentioned gold sentiment and got very, very bearish, looking at various surveys of gold sentiment, leaving it sort of susceptible to a bit of a squeeze risk there. And then you also have China coming out and saying that they're restocking, you know, encouraging loads of gold to be imported into the country, sort of lightening restrictions of gold being imported into the country. They've also released a central bank digital currency, and there's been some talk about a gold-backed yuan. And all these things kind of triggering that sort of slightly more bullish tone towards gold. And also the weaker dollar, right? The weaker dollar obviously helps kind of gold and commodities in general go higher, right? So that's the main reason. We were seeing some bearish divergence, you can see from momentum indicators, but now that's kind of, as gold's rallying, that's kind of potentially going to negate that if we start to see some more gold upside. So yeah, kind of watch out on gold, but right now I'm pretty neutral on it. Yeah. The other major commodity that I've got my eye on is copper. That resumed its uptrend pretty conclusively. So if you look here, longer term copper uptrend resuming. It held on to that retracement down to the sort of 50-day moving average level as well. Fundamentals really good in copper, as I've been mentioning for weeks. Goldman's put out a report talking about the demand drivers, the acceleration in green electrification trends that are set to drive the strongest decade in copper demand growth post 2000, right? So they see the decade for copper demand as being, you know, pretty major, right? So that's clearly, you know, good for the copper backdrop. You've also had positioning lighten up, right? So if I share my screen here, so here's a chart from Saxo showing managed money positioning in copper. It's got longs and shorts, and then you've got the aggregated net, the yellow line, kind of showing that, you know, we were looking pretty extreme in terms of positioning going back, you know, a few years. That's lightened up. It's kind of about 50% reduction in that long positioning in copper. So that suggests that the market length has gone down a bit, and that means that, you know, as the uptrend has resumed, maybe it's got some legs on it, right? Whereas we're not stretched in terms of positioning. So that's kind of another good data point for this kind of copper rally to continue. And that's kind of it for commodities. I mean, in general, like the weaker dollar has helped commodity strength across the board. You know, the grains have continued to rally, the oils continue to rally. So a lot of things looking in good shape on commodities, right? Let me just quickly bring up, you know, the oil chart, oil looking strong, wheat had a nice, I've been accumulating wheat in that correction. It had a really nice sort of bounce there. Similar story with things like soy, things like corn, you know, corn making new highs again, or recent highs, let's say. Very, very strong price action across the commodity space right now. And like I say, the dollar weakness really helping there. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.